When is the most dangerous moment in the stock market? Ask the top 1% around the world, and their answer is almost the same. It's not when the market crashes. It's when your account holds its biggest profit. Strange, right? The moment you're up the most is the most dangerous. But the data says so too. The bigger the profit in an account, the first to dump on the very first day of a crash, and they call that sell a profit realization, repeating the same mistake for a lifetime. Profit means taking profit, a loss means cutting loss. That common sense way of dividing it is actually the illusion that eats away at your account, and today I'm going to flip it completely. I've prepared just 3 things today. First, the structure of the brain that makes you more of a coward the bigger your profit. Second, the evidence of that brain moving trillions of one in the actual market, and I'll also unravel the strange paradox where the fear index went down on the crash day and up on the rebound day. And finally, 3 checklist items to gauge for yourself which side your sell is closer to. Watch to the end, and you'll realize that what you need to look at right before pressing the sell button is not the color of your account, but somewhere completely different. When you study investing, you hit a strange point. Your eye for picking stocks grows as much as you study. Reading earnings, reading charts, reading industries, your skill accumulates as you learn. But selling, uniquely, doesn't work that way. Even people who've studied a lot, even people who've been in the market for years, feel their hands tremble in front of the sell button when a crash comes. Why does skill uniquely fail to build up in selling? It's not from a lack of knowledge. You buy with your head, but you sell with money on the line, so the brain intervenes. For example, say your principal of 10 million won grew to 30 million. You're clearly up 20 million from your principal. But the next day, if your account shrinks to 27 million, strangely, a person feels not I'm still up 17 million but I lost 3 million in a single day. The moment profit is already stacked in your account and you watch it shrink before your eyes, even the most studied person has their judgment hijacked by the brain. And then we look at the result of that sell and slap on a label. If it ended in profit, I took profit. If it ended in loss, I got stopped out. But that label, slapped on based only on the result, is a fake label, and that's today's key point. Within cells that both ended in profit, an expert's sell and a beginner's sell are mixed together, and without the eye to tell them apart, no matter how much money piles up in your account, you'll shake the same way in every crash. So where is the real dividing line? Let me cut straight to the conclusion. Profit realization and bottom selling can never be distinguished by the color shown in your account. It's decided only by whether that judgment came from a plan or from fear. The problem is that the human brain is designed so it can't tell the two apart on its own. Let's take the brain apart to see why. In the first half of this year alone, Samsung Electronics rose about 150%, and SK Hynix over 260%. Anyone who bought at the start of the year and held would still pocket an enormous profit even selling at a price down 9% in a crash. But that person doesn't feel that way at all. Because the brain anchors not to the price you bought at, but to the highest price you've recently seen. It's the anchoring effect that behavioral economics talks about. The cost blurs and only the recent high stays vivid, so you feel not I'm selling with a big gain but I'm fleeing after sliding down from the peak. And one more thing layers on top. The house money effect from behavioral finance. Money won at a casino feels like the house's money, so you gamble it more boldly. It's a concept from a 1990 study by American economists Richard Thaler and Eric Johnson. It's been confirmed here too. A study analyzing 500 domestic day trader accounts from 1999 to 2005 clearly found that investors who had profited from past trades tended to take on greater risk afterward. But the real core of this study is on the other side. The moment a loss occurs after profits have piled up, the tendency to take risk drops off sharply. Put these two together and you get a frightening picture. The bigger the profit, the more your nerve swells, but that swollen nerve bursts biggest at the very first moment profit starts to shrink. In other words, the sell button in your account reacts not to the price of how much you've made, but to the speed of how fast your gains are shrinking. Like a thermometer, your brain gets chills not from what temperature the room is now, but from how many degrees just dropped. Even a warm 25-degree room, right after dropping 5 degrees from 30, makes the brain scream that it's cold. Accounts are the same. The temperature of still a big gain is invisible, and only the change of less than yesterday looms large. That's why, paradoxically, the account with the biggest stacked profit becomes the first to dump on a crash's first day. Let me draw it in numbers. Say you bought 100 shares of Samsung Electronics at around 110,000 won at the start of the year, about 11.3 million won worth. With a 178.5% rise in the first half, by the end of June the valuation is over 31 million won, and the paper profit alone is close to 20 million. This person treats that 20 million as already earned money and relaxes. But a crash comes, and if it drops 9% in a single day, that cushion is shaved by over 2.8 million in an instant. The moment they see it, the perception of already earned money evaporates, and the instinct of my money is disappearing fills its place. Even with nearly 20 million in profit still remaining, they sell in a panic, as if their principal is at risk. The account is blue, but the behavior is that of a red account. Sounds like theory when I just say it? But the scene where this exact psychology moved trillions of won actually happened last week. Last Thursday, the KOSPI crashed 7.89% in a single day. Samsung Electronics minus 9.06%, SK Hynix minus 14.57%. Yet on this day, individuals, far from fleeing, net bought 661.58 billion won of just these two stocks. And the very next day, when the index rebounded sharply by 5.76%, this time individuals net sold 2.2941 trillion won, while institutions alone bought 4.4451 trillion won and lifted the index. They bought on the crash day and sold on the rebound day. On the surface, it's perfect low buying and high selling. But here comes the question that runs through this whole video. That 2.2941 trillion won sold on the rebound day, was it profit realization or bottom selling? There's one number that answers this. The fear index. The KOSPI 200 volatility index, the VKOSPI. It's an indicator the Korea Exchange calculates from KOSPI 200 option prices, often called the Korean-style fear index. Here's what most people misunderstand. This index doesn't measure how likely it is to fall. It measures how much the market will swing, up or down, over the next 30 days. In other words, how much the market itself feels it doesn't know what's next. If you compare it to a car, this indicator isn't a brake light, it's a fog light. A brake light is a directional signal for stopping now, but a fog light, regardless of direction, signals can't see ahead. A high of KOSPI doesn't mean the market is falling. It means, whether it rises or falls, it's in thick fog where you can't see ahead. It measures not direction but the size of the unknown. Look at the chart again through this lens and it reads completely differently. On the crash day the index collapsed 7.89%, yet the KOSPI actually closed down 2.5% from the day before at 86.41. Strange, right? But dig into the markets inside that day and the reason appears. Only large caps crashed intensively, while mid and small caps held on through sector rotation. The KOSPI large cap index fell over 8%, but mid and small caps fell only 2%. The market read this not as a directionless collapse, but as money relocating out of expensive semiconductors. Collapsing and relocating have a different quality of fear. But on the rebound day, the index rose 5.76%, yet the KOSPI jumped to 89.29, right up to the threshold of 90. A rebound came, so why did the fog grow thicker? What led the rebound that day was institutional buying alone, while both foreigners and individuals sold. A rebound with only one buyer. And a looming major earnings release, a gate whose result was unknown. From the market's view, even as it rose, it couldn't tell whether this was the real bottom or a brief bounce before the gate. So the index rose while the options market priced in a more expensive insurance premium. That's the identity of the paradox where the fear index fell on the crash day and rose on the rebound day. And both days were far above the 70 to 80 range usually classified as uncontrollable panic. Normally 20 to 30 is stable, 50 to 60 is a precursor to systemic risk, and 70 to 80 and above is a panic phase. Why is this decisive for today's topic? Because the numbers tell us the rebound day's selling was not a safe sell. It looks like you sold on a green light day, but the market's fog was actually thicker than on the crash day. Of the 2.2941 trillion of individual net selling on that foggy rebound day, a considerable portion may have been not planned profit realization, but a bottom sell that arrived a day late. Let me trace the psychology of that sell. There's a person who wanted to sell on the crash day but whose hands froze. If I sell here, won't I really be an idiot, clashing with the fear of what if it drops more, and the day passes with them doing nothing. Then, the moment the first rebound appears the next day, a rush of relief, I'm saved, let me get out even now, pushes them to press sell. That scene of toggling the app on and off, then selling on the rebound day and consoling yourself, this is exactly it. On the surface it's high selling, weathering the crash and selling into the bounce. But dig to the root of that judgment, and it's just the previous day's fear, aged one day before being executed. The reason for selling is not I reached my target, but I want to escape a state that scared me. Only the price tag changed. The identity of the judgment is bottom selling. In fact, a Samsung Securities report analyzed that individuals repeat contrarian trading in leveraged products, buying on days the underlying plunges and selling on days it surges. When this contrarian trading is done without a plan, it ends up being the same as doing emotional trading twice, buying on fear and selling on relief. Even if the result of low buy, high sell is the same, the person with a plan can repeat it, while the person acting on emotion may get the opposite result next time. That's the decisive difference. So how do you check which side your sell is on? There's just one criterion. Where the gaze of your sell is looking. Bottom selling looks backward, the past high, the vanished profit, yesterday's drop. Profit realization looks forward, where this money goes next, a target set in advance. In driving terms, bottom selling is turning the wheel while staring only at the rearview mirror. Profit realization is looking through the windshield toward your next destination and taking the planned exit. What's reflected in the rearview mirror is a road already passed. A decision made while looking at a past high, no matter how good the numbers look, isn't driving, it's the execution of regret. Let me break this gaze into 3 checklist items. The first is the VKOSPI, which shows the markets now. One search on a brokerage screen or a portal and it's there. A sell pressed reflexively while the index is in a panic zone is, even if your account is blue, closer to a sell where fear moved your finger for you. Conversely, planned profit realization is mostly executed when the market is relatively stable, when a preset target is reached. The second is the next destination of the sold money. A planned sell has a destination, rebalancing into another undervalued stock, living funds decided from the start. Bottom selling just pulled out in fear, with the money's next plan sitting empty. The third is the time it took to decide. A sell made because a preset standard was reached is already decided the moment you look at the screen. A bottom sell has the finger move first, seconds after seeing the red number. If your gaze looks forward, all 3 lean toward planning. If it looks backward, all 3 lean toward fear. Here's where beginner investors get most confused. But if I made over 100% in the first half and sold on that crash day, I still walked away with big money, right? Isn't that also bottom selling? You have to separate result from process. If you sold that day according to a plan to trim half before earnings, that's excellent profit realization. But if you pressed it, startled by the -9% on your screen with no plan, you didn't walk away with big money, you cut short a chance for even bigger money out of fear. Considering Samsung Electronics rebounded over 8% the next day, that one day leaves a big difference in your account. And what's scarier is what comes after. If a sell made in fear happens to end in profit, the brain stores it as a success. Then in the next crash, you dump faster and bigger. The moment an accidentally right fear sell becomes a habit, a day comes when you dump everything at the real bottom. The true cost of bottom selling isn't this loss, it's your behavior in the next crash. Of course, blind optimism is forbidden too. Let's check the risk factors objectively. First, don't take this logic as just hold no matter what. The house money effect is a concept explaining the psychology that clouds judgment. It's not a hall pass to hold. If earnings turn down or your investment thesis breaks, selling is right even if the VKOSPI is low. Second, an account run on debt can't use this checklist at all. With margin or leverage, if the collateral ratio breaks, the brokerage force liquidates, so the account balance decides for you, plan or no plan. Today's standard assumes an account invested with your own money only. Third, a low VKOSPI isn't automatically safe either. In a phase where bad news like an earnings deterioration or a cancelled contract is quietly progressing, a low index itself can be a trap. The fear index is a thermometer of market sentiment. It doesn't show the inside of an individual company. Fourth, the 2 days of numbers we covered are living data. Depending on this week's major earnings events, the fear index and the supply-demand can swing greatly again, so take it not as a fixed conclusion but only as material for judgment. So how did the experts see these 2 days? Daishin Securities analyzed that with the large-cap semiconductor concentration intensified, profit-taking simply overlapped in the process of unwinding overheating, and that a sharp drop that doesn't damage earnings momentum tends to lead to a strong rebound. Yuanta Securities also noted that this correction was volatility from overbought conditions and profit-taking amid concentration, not an AI demand slowdown, and that short-term volatility must be distinguished from a company's long-term competitiveness. What do these two have in common? They look not at the backward of the drop size, but at the forward of earnings outlook and contracts. Neither used the size of the drop itself as grounds for judgment. They first sorted out whether that fall actually damaged the company's intrinsic value, or was a process of the whole market's concentration unwinding. While individuals looked at the drop percentage on their screens, institutions were looking at the next quarter, and that difference in the direction of the gaze showed up as the exact opposite behavior the day after the crash. Institutions buying 4 trillion, individuals selling 2 trillion. We have to be able to see the bigger picture here. Your eye for picking stocks grows with study. But the gaze of your selling doesn't change by study alone, it hardens only when you check yourself each time you go through a crash. Right now the Korean market has 2 semiconductor stocks concentrated to an extreme in market cap, with leverage money piled on top, so days moving 7 to 8% aren't the exception, they've become the default of this market. In other words, the moment when fear and plan collide in front of the sell button will come several times a month from now on. And only the person who checks each time, with these 3 checklist items, whether their gaze looks forward or backward, will end up on the same side as the institutions in the same crash. So let me wrap up. Profit realization and bottom selling are divided not by the color of your account, but by the source of the judgment. Plan means profit realization, fear means bottom selling. And because of the house money effect, the bigger the account's profit, the more it reacts to the speed of shrinking gains, leading to fear selling even while in profit. Even a sell on a rebound day can be a bottom sell that arrived a day late, as the higher fear index on the rebound day actually showed. The market's fear measures fog, not direction, and a beginner's sell comes out while watching the rearview mirror inside that fog. What we investors truly need to watch is not the color of the account, but the gaze of the sell. Are you selling while looking at the high behind you, or the plan ahead of you? Remember just this one thing today. Right before pressing the sell button, check only 3 things. Is the VKOSPI right now in the safe zone of the 20s to 30s, or in the panic zone? Is the next destination of the sold money decided? And was this decision already made before you looked at the screen? If all 3 are yes, it's profit realization. If all 3 are no, then no matter how deep in profit you are, it's a bottom sell. Don't forget that. If today's story helped, leave a like, and if there's something you're most curious about while investing, drop it in the comments. I'll be back with data in the next video.